All right, look, we got to get right to it. I mean, we're sitting, roughly 5,900 on the S&P 500.
Yeah.
Higher than where a lot of folks thought we were going to end the year. And I know we still got a month and a half to go here. But everyone's already looking out to 2025. Have you actually taken a look at 2025? Are you ready to make a forecast?
Yeah, we've been hard at work on our year ahead investment outlook. And I think for us, it seems like the economy has now emerged from the kind of cyclical storm of uncertainties. You know, we're firmly in a soft landing. Growth is resilient. Inflation's on its way down to 2%, and the Fed is easing. But we are entering this kind of fog when it comes to uncertainty around policy, what this next administration will bring. I think for us, what we need to anchor ourselves around is just the direction of travel, and that remains very well intact, that the economy continues to grow, earnings growth is broadening out, and there are many other areas of the markets that can now perform better in the year ahead, and we're not only relying on just 7 companies in the index.
Well, let's talk about that, because that really was the market story, at least for the first 6 to 8 months of the year. We've seen a bit of broadening since then, not quite as much as some people would think. What do you think is going to be the leadership for this market over the next 12 months? What sectors?
I think tech will remain intact, but they're going to continue to kind of come to head with this attention on monetization. So I think the fact that expectations are elevated for those companies could potentially lead them to lag, particularly relative to the last 2 years of performance. But what we're most excited about is just that other areas of the markets now seem to have the tailwinds behind them. So you just have growth being resilient, interest rates coming down. We're expecting them to come down a bit more, particularly on longer term rates, but that's helping other areas of the markets, particularly value. And then also some tailwinds from the election impacts, deregulation and tax cuts, which will also help other areas of the markets perform.
So is that a financials call? Because it feels like that's more the consensus, like the way to play that whole theme you just said, financials.
The outlook for financials does seem to be robust, or at least better than last year. I think on the regulation front, similar to many other things on the that are being talked about from this next administration, we don't know yet what deregulation actually looks like, and we don't know what the magnitude of that is. And particularly in financials, where it's a very differentiated landscape, there's a lot of smaller regional banks. Does lower regulation actually help competition amongst them? And so there's a lot of questions you still need to answer, but it does seem like that the outlook there is looking a bit better.
Does that extend to, say, small caps and mid caps also?
It does. I think that earnings growth, particularly there, that is expected to be quite robust next year. And earnings there was really in the doldrums for the last 2 years, particularly relative to large cap tech. So we do think that small and mid cap have more room to perform here, and particularly because their valuations just haven't risen as much as large cap tech either. So there's more room for upside.
Is there a case to be made at all for U.S. investors to actually look outside the U.S.? There's been a lot of talk about American exceptionalism when it comes to financial markets, particularly in light of the administration that's going to be coming into power, that most people seem to believe is going to be very market friendly.
Over the long term, we think there's a lot of growth happening globally, not just in the United States, and particularly where expectations are much lower and perhaps the upside is elevated, and there's really exciting structural themes, particularly in Japan and in India. In the near term, I think we had expected the dollar to weaken next year, and now it seems like the dollar will be biased higher with the balance of policy and U.S. growth and this theme around U.S. exceptionalism. So in terms of just beta exposure, the rest of the world seems a little bit more challenged than we initially thought. But with that said, underneath the hood, we do think there's a lot of opportunity, particularly in some of these secular themes like AI, technology, healthcare.
When you sort of look ahead into 2025, and particularly through the lens of what government policy is going to be like, are you going to pay more attention to the White House or more attention to the Fed and Jay Powell?
Ooh, interesting question.
Interesting question. For the last 2 years, we've really only looked at the Fed, right? Monetary policy has been squarely in focus, and now investors have to really take issue with the direction of fiscal policy. It seems like monetary policy in the year ahead will be gradual. The Fed is lowering interest rates. There's a lot of questions around where the neutral rate is. Maybe it's more elevated relative to history, but the uncertainty there seems a bit more muted relative to the past, particularly because now inflation is back to 2%. So it seems like fiscal policy and the focus around there will very much be in the driver's seat for the next year.
So how do you then diversify? Do you go into Treasury market in the long end if we're sitting around 4.5? Is it going to be crypto? Is it going to be gold? Where's a good diversifier for you guys?
I think first you have to see where your exposure is. And for most investors that are sitting on portfolios that have enjoyed the last 2 years of incredible performance, chances are you have an overexposure and overweight to large cap tech companies, particularly just a few companies. So I think diversification takes many different forms and flavors, and it obviously depends on your own needs. But I think you can look to diversify within equity markets now that other areas of the markets are set to perform better. Diversify into fixed income, various parts of the curve. I think long-term rates will remain pressured given the current macro backdrop, but there are that diversification offering there, and then also private markets and even other real assets that can help buffer portfolios right now.